All right. So again, kind of like I just said, we're talking about avoiding capital gain bump zones, strategies around making your non-qualified accounts tax efficient by avoiding double taxation. And so we've talked about a few double taxation hurdles in this group before. A big one that we've talked about, in most presentations is something called the Social Security tax torpedo. Well, there's actually another double taxation hurdle that we refer to as a capital gain bump zone. And this is something that is going to apply, I think, very widely to the members in this group. And at the beginning of this, there's everything in retirement is interconnected. Okay, there's layers to everything, and it creates a situation where there's an overflowing problem in retirement that I want everybody in this group to be cognizant of, because it happens where essentially one problem can overflow into other problems. And so it can create a kind of a cascading effect. And RMDs are a big culprit of this, where an RMD that you may or may not want to take ends up pushing you into different hurdles. And this capital gain bump zone is one of those overflowing problems that when it begins, it's a difficult one to stop, especially when we're talking in terms of RMDs. But as we talk through what this capital gains bump zone is, there are a few important terms to know right from the offset. So when I'm talking about a taxable account, a non-qualified account, I'm talking about accounts outside of your Roth IRAs, your traditional IRAs. So this would be like a brokerage account. Again, you'll often hear it referred to as a non-qualified account, a community property account, a joint account with survivorship. All of those type of accounts are what we're going to refer to as taxable accounts. Anytime there's interest in those accounts in a given year, anytime you make a investment change, it translates to you owing taxes in some form. Okay. Something we'll talk about as well are realized gains and unrealized gains. Okay. So basically what unrealized gains would be, let's say that you bought Apple stock 3 years ago and you purchased $50,000 worth of Apple stock and it's now worth $75,000. Well, if you haven't sold Apple stock, that's what we would refer to as a $25,000 unrealized gain. Selling that stock would then realize that gain. So anytime you're realizing gain, it means there's the opportunity for that to move onto your tax return. Okay. If you've held that investment for more than a year, that realized gain is going to be what's referred to as a long-term capital gain. This is going to be the primary focus of today's presentation, is talking through these bump zones that are created in terms of long-term capital gains. And this would be, again, gains from investments held more than a year. Gains from investments held less than a year are short-term capital gains. Okay, long-term capital gains have a preferred tax rate. Short-term capital gains have normal ordinary income rates. So we generally want to avoid short-term capital gains, mostly at all costs, and only realize long-term capital gains. Okay. So again, just getting some key terms out of the way for anybody that might be confused as we move into the meat and potatoes of this presentation. Long-term capital gains, as I mentioned, have a preferred rate. So varying withdrawals, when you withdraw money from a taxable account and you sell an investment that you held for more than a year, again, it's going to be long-term capital gains. Well, these are preferred rates. Basically, the IRS wants to give you a benefit for holding and being a long-term investor, investing back into the economy in these type of accounts. So they give you a preferred rate versus income rate. So let's say that you're a single filer, okay, and you have $75,000 of taxable income. Okay, so for income rates, if you realize if you pull from a traditional IRA, and therefore that'll be taxed at ordinary income rates, you're going to be taxed at 22%. Well, if you pull from a taxable account, long-term capital gains, you'll actually be taxed at 15%. So at every zone, you'll see that realizing long-term capital gains will have a lower tax rate than realizing essentially something that would be classified as ordinary income. Okay, but it's basically how these the long-term capital gains rate and income rates stack together that creates what's this capital gain bump zone. Okay, so let me kind of explain how this bump zone is created. What I want to note here is for if you're, let's see, I'm using a married filing jointly. So if you're married filing jointly at 80,800, if your taxable income rises above 80,800, okay, your long-term capital gains are taxed at 15%. If your taxable income is lower than 80,800, okay, you will be taxed at 0%. Okay, so from 0 to 80,800, you're taxed at 0%. So that would be from there to there. From 80,800, you're taxed at, from 80,800 to 501,000, you're taxed at 15%. And then anything over 500 and 1,600, you're taxed at 20%. Okay, well, it's these step ups as we get into higher zones that creates what's called this capital gain bump zone. So let me explain how this works. Let's say we have a couple, they're 62 and they're 63. Okay, and they're pulling $95,900 from their traditional IRAs. So that's all ordinary income taxable. And then they have $10,000 of long-term capital gains on top of that. So their AGI before the standard deduction is $105,900. Their standard or their income, their taxable income, which would be after the standard deduction, is $80,800. So they're not yet bumping into this 15% zone. So they are not subject to what we would call this bump zone. As you can see, as I lay this out over here on the right-hand side of the screen, always know that long-term capital gains stacks on last. So these IRA withdrawals will be the foundation, if you will. Long-term capital gains will stack on last. So you'll see that these IRA withdrawals are taxed at 10% here and then 12%. And then because they're not over this 80,800 mark for taxable income, their long-term capital gains are still over here in the 0% zone. So they're not going to owe any taxes on this long-term capital gain right here. Okay, so they are not subject to this bump zone. Now let's change these numbers a little bit. Let's say for whatever reason, they wanted to go on a nice big trip to celebrate, their 40th anniversary or something like that. And so they're taking an extra $10,000 from their IRAs. Everything else is the same. So their IRA withdrawals before were $95,900. They're going to stack on another $10,000 there. They're still going to have long-term capital gains of $10,000. So now their AGI is going to do what? It's going to go up $10,000. Their taxable income is obviously going to go up $10,000. But now what happens to these long-term capital gains? So these IRA withdrawals now fill, again, taxed at 10%, taxed at 12%. And now they're over a point where they're $10,000 over that 80,800 mark. So now their long-term capital gains, rather than previously being taxed at 0%, now it's going to be taxed at 15%. So what happened there? That extra $10,000 of traditional IRA withdrawals moved what was previously a 0% tax rate for capital gains to now being taxed at 15%. So the extra $10,000 of withdrawals overflowed and created a different problem in their retirement. It created their long-term capital gains to also be taxed. So their marginal tax rate on this $10,000, extra $10,000 of withdrawals, is going to be significantly higher than they probably thought. So intuitively, what's going to happen? Now, if we go back, their IRA withdrawals are taxed at 12%. So they think if they're going to pull another $10,000, they're just going to be taxed at this 12%. And that is what happens. Okay, so intuitively, they think they're, again, $10,000 withdrawal, taxed at 12%. They should owe $1,200 in taxes. And that does happen, but they're missing part of the equation here. So they do owe that tax, but then again, their long-term capital gains moved from being taxed at 0%, now taxed at 15% because of that extra $10,000 withdrawal. So we have to also factor that in. They had $10,000 of long-term capital gains taxed at 15%. It's going to be $1,500. And so their marginal rate on taking that extra $10,000 was actually 27%. They think it's 12%, but it's actually 27%. Again, because of this overflowing problem, it moved that long-term capital gains into being taxed. So this is what we call the capital gains bump zones. Taking money from another account bumps their long-term capital gains up into being taxed as well and raises their marginal rate. And so what's going to happen? I should say, we'll show how there's 3 different bump zones, but before I need to set up essentially an additional bump zone that's created. And it's created because of something called the net investment income tax. So basically, a few years ago, basically because to help fund Obamacare, they made a surtax where if you make for a single filer, if your income threshold is over 200,000, or for a married filing jointly, if your income threshold is over 250,000, there's an additional 3.8% expense tax on long-term capital gains. Okay, so before we saw, if we go back up, we saw there were three increases. There's also a middle increase in here as well, where you have to tack on a 3.8% expense. So it's actually 0%, 15%, 18.3, and then 23.3, or sorry, 18.8, 23.8. Okay, and this will make sense here in a sec, but essentially there are now three different bump zones that are created. The worst bump zone is actually, surprisingly, this bump zone right here. When you go from being, your long-term gains go from being 0% taxed to 15% taxed. But then there's another bump zone when you are now subject to net investment income tax, where you have an extra 3.8% surcharge on your long-term capital gains rate. So that creates the second bump zone here. And then there's the third bump zone where you go from essentially crossing over from being taxed at 15% now at 20%. But again, we have to add in that 3.8% charge. But this one right here is the worst bump zone. It will also be the bump zone where the majority of people in this group will be subject to. The majority of people, period, will be subject to, because it happens at lower income levels. So this is going to be one we focus primarily on, but just know there are two extra bump zones as well, depending on how much taxable income you have. The second bump zone obviously would come at 200,000 income threshold, 200,000 for single filers, 250,000 for married filing jointly. Okay. And so an important thing to think about is the size of this bump zone will vary depending on how much you have in long-term capital gains. So previously we've talked about the Social Security tax torpedo and how that varies for everybody depending on how much you have coming from Social Security. Well, that Social Security tax torpedo would vary again differently for everybody. The spot where that you would see those increases in taxes would vary. For the capital gain bump zone, these are located in the same spot on everybody's tax return, or on everybody's tax graph, I should say. But what the size of these bump zones will vary depending on how much you have coming from long-term capital gains. So for instance, if we have $10,000 in long-term capital gains, the width of this bump zone will be 10,000. And why would that be? Well, essentially every dollar that you take an extra traditional IRA income is going to move $1 into being taxed at 15% in this bump zone. So the bump zone will be as wide as you have long-term capital gains, if that makes sense. Okay, and you're going to be taxed again at 27% because again, you're moving, you're in the 12% bracket here. Okay. And so you're going to be taxed at 12% on the IRA withdrawal and then 15% on the long-term capital gains, thus adding up to 27% for a marginal rate. Now, if you had $50,000 of long-term capital gains, well, guess what? This bump zone is $50,000 wide now. Again, this makes sense because as you take and add more taxable income, it's moving more of your money into being taxed at 15%. And so that's gonna begin with every dollar you're going to take in additional taxable income. It's going to move $1 of those long-term capital gains and being taxed at 15%. So it's a $50,000 wide bump zone, if you will. Okay, and every bump zone thereon after is going to be just as large as well. And so again, this creates, when we start stacking some of these hurdles on top of each other, and so this is the long-term capital gains bump zone stacked on top of the Social Security tax torpedo, we see this overflowing nature of tax planning. Okay, so if I were to ask you what's one of the highest tax rates that you could be taxed at, marginal rates that you could be taxed at in your situation, many people would intuitively say 37%, because 37% is the highest marginal, or is the highest highest tax bracket in the ordinary income tax system. Some of you that have watched some of our videos might say, no, it's 40.7 because of the Social Security tax torpedo that we see here. Well, actually, because of the capital gains bump zone stacking on top of this this Social Security tax torpedo, it actually rises even higher to almost 50%. And so how does this happen? Okay. And I'm going to try to explain this as best as I can, but I understand this is confusing in nature because we're stacking multiple tax hurdles on top of each other. So let's say you're in the 12% bracket and you withdraw $1,000 extra dollars. And let's say that you have $5,000 here of long-term capital gains. Prior to withdrawing this $1,000 extra from your traditional IRA, you aren't subject to this capital gain bump zone at all. All of your long-term capital gains are tax-free. They're at the 0% rate. Well, withdrawing that extra $1,000, you're taxed at 12%. So you think that's going to translate to $120 in taxes. What actually happens, though, as we previously described, this $1,000 withdrawal does move $120 into becoming taxable, but that $1,000 also moves $850 from your Social Security benefit into being taxable as well, because it's raising your provisional income. It's causing more of your Social Security benefit into being taxable as well. So that's called the Social Security tax torpedo. Okay, but then remember, this $1,000 plus $850 becomes or raises your taxable income. So it's going to move $1,850 of your long-term capital gains now into being taxable. So we have to add another $277.50, which would be this taxed at 15%. We have to add that into the equation as well. And so it creates a situation where that $1,000 withdrawal, you're losing $499.50 to taxes. And again, I know I'm kind of going over this fast, assuming you guys all know and can intuitively calculate out the Social Security tax torpedo. So you're gonna have to trust me a little bit on this if it's a little bit confusing. But essentially, it's stacking these tax hurdles on top of each other that can create some really high marginal brackets. Now, again, this marginal bracket only exists for a range of, I believe it's like $5,000 worth of income in this example. But nonetheless, this is money where the last thing you would want to do, is pull this $1,000 from a traditional IRA source. You'd want to instead pull it from a Roth IRA to avoid this essentially this tax event that is created here. Okay. So how can you avoid, now that we know about the capital gains bump zone, how can we start to avoid it? Okay, and we have 5 different taxable account rules. Not all of these will translate into helping avoid the capital gains bump zone, but it will make your taxable account more efficient. The biggest one here to avoid additional long-term capital gains and thus avoid this capital gain bump zone is to not hold mutual funds in your taxable account. Now, why would that be? And what else should we hold if we're not holding mutual funds? Well, mutual funds tend to be very tax inefficient. So our goal with this taxable account, with this non-qualified account, is we want any income coming from that account, we want complete control over. So we don't want to find out at the end of the year that, hey, you had an extra $5,000 of income that's now taxable come from that taxable account. We want to control if we take that $5,000 or not. Okay. The 5 rules here, just to kind of go over them. Don't hold mutual funds. Don't hold bonds. Reason you don't want to hold bonds is that's interest each and every year that becomes taxable. Don't hold high dividend stocks. The reason being all of those dividends become taxable in that given year. So you want to hold low or no dividend stocks because, again, we want to control the income that comes from that account. Don't reinvest dividends. Why would you not want to reinvest dividends? Well, if you do have dividends, if you need income in a given year, you want to just be able to take those dividends and not have to sell an additional asset in order to take income. The other thing is, okay, if we're investing, let's just say we're investing 50% of our money in US stocks and 50% of our money in international stocks in this account. Well, if we're reinvesting dividends and US stocks go on a run where they have a fantastic run relative to international stocks, we're going to hit a situation where we're no longer 50-50. Okay, now to rebalance, let's say we're in a situation where 65% of our assets are now in a US stock fund, and what would that be? 35% of our assets are in the international stock fund, just from a performance standpoint. Well, if we're reinvesting dividends, we're constantly widening this gap. And to rebalance back to 50-50, we need to sell and therefore generate income, generate a taxable event. So if you're not reinvesting dividends and you're instead reinvesting and rebalancing those dividends back to where you want, that's a much smarter approach to make it tax efficient over time. Finally, don't hold multi-asset funds. Don't hold things like target date funds or balanced funds, because again, those will hold partially. They'll have money in bonds. They'll partially have money in stocks. Well, to exit those, you're going to have to, because we want to exit those from a standpoint of not holding bonds, you're going to have to sell stocks that probably have unrealized gains in them that will create a taxable event. So again, don't hold multi-asset funds. Separate all of your funds. If you want to hold real estate, if you want to hold stocks, if you want to hold specific asset funds, don't hold multi-asset funds. Okay, so we'll come back to this as well. We'll come back to this mutual fund example. This slide I think actually should have been slightly later in the presentation, but let's talk about kind of another overflowing example here that can translate to this capital gain issue. Okay, many of you have seen this type of tax graph that we've had in certain presentations. Notice early in retirement, they're in some lower tax brackets. Later in retirement, because of RMDs starting at 72, we see this raises these RMDs push them into much higher tax brackets. So this is a situation where this RMD is going to create essentially an overflowing problem. And it's going to create a circular argument or a circular problem that's very difficult to get a hold of once it's started. So what do I mean by that? Well, this person is obviously going to have a large excess RMD. We see here these RMDs are going to be anywhere from $200,000 to $300,000 RMD. So this is a situation where this person has quite a bit of money in traditional IRA assets. Okay, so if they don't deal with that RMD problem, what's going to happen? Well, these large RMDs are going to push them up into higher brackets. Okay, if they weren't already subject to this first bump zone, it's certainly going to push them into that first bump zone. It might push them high enough where they're now subject to that net investment income tax, so tacking on an extra 3.8% tax. If the RMDs are large enough, it could push them through every single bump zone, and they have no ability to do anything about it. Anytime they realize long-term capital gains, they're going to see each of those bump zones because of a large excess RMD. Well, again, if they take that RMD, they're going to have to pay taxes on that RMD, but they don't have a real need for that RMD. It's not going to contribute to their income need in a given year. It's an excess RMD. So this excess RMD now needs to go somewhere, right? This excess RMD, again, they could spend that, they could give that money away if they want, but let's say they want to retain it and build wealth in order to pass money on to the next generation. Okay, well, most likely they're going to put some of that excess RMD and they're going to invest it in their taxable account. Well, what's going to happen if they invest that money in their taxable account? Well, their taxable account is going to get that much larger. And so it's going to generate that much more in long-term capital gains over time if they utilize that taxable account. And so now we see a situation where it's essentially a circular problem where these large RMDs put them into bump zones. Well, then they put more of the excess RMD into their taxable account, which generates more long-term capital gains, which widens that bump zone, the width of that bump zone, thus raising their marginal rate through each of those bump zones. And so it's a huge, this is why RMDs are so important to take care of, because they overflow into so many other problems. In this presentation, we're talking about capital gains. So we'll see the circular nature of this overflowing problem. Okay, so let's go back. Let's kind of bring back and talk about why you shouldn't hold mutual funds, why you should hold more tax efficient ETFs. And so a problem with mutual funds is when they buy and sell mutual funds, the structural, essentially the way that mutual funds are structured, they pass through all of these tax liabilities through to whoever owns the mutual fund. So for instance, we have the American Funds Growth Fund of America here. And I'm not picking on just this American fund. This is an issue with all mutual funds or many mutual funds, is that they're tax inefficient. Anytime they're making a change, that change is passed through to you, the investor. And obviously, if you own that mutual fund, you can't choose whether to take that long-term capital gain or not. It's, again, passed through to you. And so this is a situation where if we just take their distribution history, you can find this on Morningstar. We look at 2020, you'll see that they have a few different types of distributions in here. They have income, which is likely going to be dividends. Dividends are passed through to the investor. But then you'll see here, they generated $2.73 of long-term capital gains. So this is from making different moves inside of their fund that's then passed through to the investor. Okay, now their NAV, so a share cost of American Funds, Growth Fund of America, Class A share, was $67.15. So basically what we're going to do, we're going to add all of these together, but the majority of this we can see is long-term capital gains. So this is going to create an issue with the bump zone. $2.70. So we're going to add back in the income. Their total distribution in 2020 was $2.97, dividing that by a share price of $67.15. We see their forced income is 4.3%. And the majority of this was long-term capital gains they were forced to take. So let's say they had, let's just make it easy. Let's say they had $100,000 invested in this American Funds Growth Fund of America in their taxable account. Let's just round it, and part of this was dividend income, but let's just say 4% of this was long-term capital gains. So of that $100,000 account, they had no choice over this, and now they have $4,000 worth of long-term capital gains that they were forced to take because they invested in a mutual fund. Well, can this problem be fixed by investing in a different vehicle? And the answer is yes, by investing in a more tax-efficient ETF. Now we're comparing apples to apples here. We're comparing a Vanguard Growth ETF. What you'll notice is the Vanguard Growth ETF is much more cost-effective. Performance will be very similar. Vanguard Growth ETF should actually probably be better performance because it costs less. But that's not the point here. We're focusing on taxes. Notice if we look at all of these distributions, and obviously they break up distributions where it's not just a yearly distribution, there are quarterly distributions here. You'll notice that it still generates that same dividend income or similar dividend income, I will say. But there's no long-term capital gains here because it's not a pass-through entity. Okay. And so now we'll see if you take the distribution throughout the entire year divided by the share price, the forced income is only 0.66%. And this is because dividends that this Vanguard Growth ETF holds need to be passed through to the investor. So all of this is dividend income. This forced income is dividend income. You would have the same forced income if you held those stocks individually. Important thing being here, there are no long-term capital gains. The only time you'll generate the long-term capital gains here is if you sell this ETF and you generate it. But again, we're only doing that and if we want it on our tax return for that given year. So again, you can start to see how to control these capital gains coming from this fund or from your taxable account. We only want these long-term capital gains when we decide to. Because again, if you're holding mutual funds in this previous RMD example, if you're holding mutual funds and this this taxable account is getting bigger and bigger, well, what's going to happen to these long-term capital gains that you're forced to take? You're going to be investing more in mutual funds. Those mutual funds are going to still be releasing those long-term capital gains, which means more of that money is being moved to your tax return, pushing you into a bump zone. And so holding ETFs can be a lot better strategy. So investing for control. A good portfolio would be investing in ETFs. ETFs are more tax efficient than mutual funds on average. So that would be creating a bad portfolio here would be holding only mutual funds. You can go one step better and hold individual stocks, direct indexing, direct stock investing. Usually you have to have a fairly large taxable account for that to make sense as opposed to ETFs. But nonetheless, that would create a better, more tax efficient portfolio because again, you're controlling all of the income that's coming from that account. Then you can also invest in non-dividend stocks as well. And so a lot of people think, okay, if a stock releases a dividend, that means that stock is solid. It means obviously they're releasing a dividend, they have profits. And so there are no good companies that don't have a dividend. And so I went into a stock screener, and just screened for companies that don't have a dividend. You'd be surprised at some of the names in here. Google doesn't release a dividend. Amazon, no dividend. Facebook, Berkshire Hathaway, Warren Buffett doesn't release a dividend. Tesla, PayPal, Disney, Adobe, Netflix, all of these companies do not release a dividend. So these would be great companies if you were direct indexing. Some of these companies, and this isn't investment advice speaking on any of the financial standing of any of these companies. I'm speaking from a tax perspective. Okay. There are a lot of great companies that can be purchased that don't release a dividend. And if you wanted to, these are just screening for size. So these are the biggest companies at the top, screening and going down. If you wanted to screen based on something like price to earnings, looking at companies that theoretically should be a better value, you can do that as well. Also some giant companies in here. And so again, there are a lot of non-dividend options for investing. Now, again, this doesn't factor as much into capital gain bump zones, but as far as controlling your taxable income and not investing in high dividend stocks, there are a lot of great stocks, a lot of great companies that don't release a dividend that you can hold in a taxable account. Hold high dividend stocks. They're great. Okay. But hold them in a tax protected account like a Roth IRA, like a traditional IRA. Something to speak about that I think a lot of people should be doing if you qualify for it, but be careful, because if you're not careful, you'll drift up into this bump zone, is something called tax gain harvesting. So let's say that you're married filing jointly. You have a taxable account and your taxable income at the as we move towards the end of the year is sitting at $60,000. Okay, you're married filing jointly, so you're in this long-term capital gain zone here of 0%. Again, your taxable income is $60,000, so you have theoretically $20,800 where you could realize long-term capital gains at 0%. This is called tax gain harvesting. Okay, at the end of every year, you're looking at the room that you have in your taxable account, and you're looking at your taxable income, and you're going to look at how much you can realize at preferred rates. Now, you might, at some point, you might want to realize gains at 15% if your income is that high. But for most people, when we talk about tax gain harvesting, we're talking about realizing here at this 0% rate. Now, the reason that I say beware, be careful of tax gain harvesting, and basically, again, just to kind of go over if I wasn't clear enough, what tax gain harvesting is if you have additional room in your taxable income in a given year, realize some gains because you're realizing them at 0%. So you want to realize enough gains that you stay in this 0% bracket. You don't want to go over this because then you're entering that capital gain bump zone. But again, tax gain harvesting makes a lot of sense. Tax gain harvester, beware though, beware of this capital gain bump zone. If you miscalculate and you realize, let's say $5,000 too much in gains, well, you've just forced yourself into this bump zone by $5,000. Okay, so be aware as you're tax gain harvesting. Okay, and so what are some other ways you can use to avoid this bump zone? Okay, so we're taking that same situation we had before. This person subject to this bump zone, they needed this extra $10,000 withdrawal. They took it from traditional IRA assets. They shouldn't have done that because of this bump zone. They're being taxed here at 27.7%. Okay, what should they do instead? Well, if they needed $10,000 more to go on their vacation for their 40th anniversary, let's say, they should have taken it from Roth instead. Okay, why? Because they would have avoided, they still would have guaranteed this long-term capital gains is taxed at 0%. This Roth withdrawals obviously taxed at 0%. So they would have avoided that marginal rate of 27%. Okay, and this is why, again, we've harped on it in some of our YouTube videos. I know I've harped on it before in some of these Wealth Wednesdays. It's so important as you go through time to know what your future tax brackets will look like. Okay, to know when should I be using traditional IRA money to avoid RMDs or minimize RMDs. When should I be doing a Roth conversion? Which account should I be taking from at which time? Okay, you want to. This is a marginal rate tax graph, and basically what it shows as you're taking Social Security is included here on the background. As you're taking more taxable income down here, what brackets will it push you into? Okay, and this is extremely important to know what this looks like going through time, so you know how to make withdrawal decisions in retirement, which accounts to withdraw from. Should I be realizing long-term capital gains here? Should I be avoiding long-term capital gains? Should I be taking from traditional IRA assets, or should I be taking from Roth assets? Again, this is going to depend on what your tax liability looks like going forward in time, what it looks like going this year. But again, you won't know how to make these proper decisions unless you know what this marginal tax graph looks like as we move through time. So in summary, this is a little bit more of I should say this type of concept, this capital gains bump zone, similar to the Social Security tax torpedo, I completely understand can be a very confusing hurdle. Okay, it's one of those things that when I was learning about this type of stuff, it took me 2, 3, 4, 5 times reading through examples in order to get it. If anybody has any questions down below, please let me know. Okay, in summary, this capital gains bump zone is created when you move long-term capital gains from being taxed at 0% and you move it unintentionally into being taxed at 15%, or you move it from being taxed at 15% to 18.8%, or you move it from being taxed at 18.8% to 23.8%. Okay, there are 3 different bump zones that you need to be aware of. The first one happens for married filing jointly when you cross over, your taxable income crosses over that 80,800 mark. For a single filer when they cross over 40,400. So those are fairly low taxable income levels, which means a lot of you that have a taxable account will be subject to whether you realize it or not at some point in your retirement. I would highly recommend everybody make sure they have a plan built that realizes when those capital gain bump zones occur and how you can avoid that. Okay, again, because it's a double taxation. You're taxed both on the IRA withdrawal and then you have that extra tax on long-term capital gains. Again, though, if anybody has any questions, we're here as a resource. Feel free to ask them in the comments below. If there's a concept that a lot of people have questions on, that lets me know that's a concept that I should explain better or go more in depth into. Okay. Always remember, you don't need more money. You need a better plan. You need to avoid the capital gain bump zone. Keep more of your money in your retirement and out of the tax man's hands. Okay. Thanks for watching. Hope you all enjoyed this presentation. We'll see you again next week for next week's Wealth Wednesday. Have a great rest of the day, everyone. Thanks. Bye.